Section 2 of Banking discusses the Federal Reserve System. Questions we're going to answer during this section are: how do actions of the Federal Reserve impact our economy? In the pictures you see, to the very far left is our Board of Governors building in Washington, D.C. To the very right is the Federal Reserve Bank in St. Louis, Missouri. And in the center is Janet Yellen, our current Board of Governors chairperson. So the Fed's structure is organized in 3 tiers. A 7-member Board of Governors who sets monetary policy, in which Janet Yellen sits at the helm. A 12-member Federal Open Market Committee, also known as the FOMC, who sets the Fed funds rate to be charged by Federal Reserve banks. All board members sit on the FOMC. This interest rate is the interest rate in which banks borrow from one another. 12 regional member banks are located throughout the United States, and they report to the 7-member Board of Governors. Missouri is the only state that has 2 Federal Reserve banks, one in St. Louis and one in Kansas City. In our Federal Reserve banks, they're staffed with economists who provide reports on our regional areas to discuss topics like unemployment rates, income changes, and job opportunities. The Federal Reserve is a result of the Federal Reserve Act in 1913. So on the map you can see where the 12 regional offices are for the Federal Reserve banks. So what does the Federal Reserve do? Their number 1 priority is to set monetary policy through the increasing and decreasing of interest rates. The goal of the interest rates are to adjust and have low employment and have stable prices. The next is they provide financial services to banks around the United States, and it's also the U.S. Central Bank, the bank in which banks use, and the bank in which our government uses. And their third function is to create regulations and supervise banks, so supervises national banking system to protect consumers. So how does the Federal Reserve affect the economy? Well, through that monetary policy I discussed earlier, they can stimulate our economy, and this is needed when unemployment rises, gross domestic product declines for 2 consecutive quarters, and price levels fall, such as deflation. When this occurs, the FOMC votes to buy bonds on the open market from investors, causing interest rates to rise, making our economy bigger. This causes the cost of borrowing to decrease and savings interest rates to decrease, but then encourages individuals to buy, which should stimulate our gross domestic product, which would cause employers to hire more employees, which would cause unemployment to decline, and hopefully price levels to stabilize. When our economy is growing too fast, we may need to slow it down, and this is needed when our price levels are rising faster than household income, and we call this inflation. This is the general rise in price levels. Also, when unemployment is below the natural rate of unemployment, when it hovers below 4 or 5%. When this is happening, the FOMC votes to sell bonds on the open market from investors, causing interest rates to rise, making our economy smaller. This causes the cost of borrowing to increase and saving interest to increase. This isn't going to discourage people from buying and slow down our economy, to lower price levels and to get unemployment more stabilized. So what's an interest rate? Well, this is the monthly effective rate paid on borrowed money or to savers at a bank. It is expressed as a percentage of the sum borrowed. So such as an example of a 30-year mortgage rate, before the Great Recession, mortgage rates were at 6.53. Since we've had a strong buying of bonds through the Federal Reserve System, our current interest rate in 2017 is 4.17%. A 5-year car loan back in 2007, before the Great Recession, we were highly prosperous, was a 7.92 and currently hovers around 4.45. And savings rates have declined significantly, 5.33 in 2007 and 2017.15. So what is inflation? It's a rise in general level of prices. So if you bought a bag of groceries in 2016 for $50, a rise in price levels would cause that same bag of groceries in 2017 to cost $55. This decreases my purchasing power. Inflation affects how much your income can buy when prices change. When prices rise, you can afford less goods and services. When prices fall, you can afford more goods and services. This affects employment because when you need more goods and services, you're going to hire employees. When you need less goods and services, you're going to lay off employees. So how does this impact you? Well, interest rates on loans either will increase or decrease depending upon the monetary policy. This affects the cost of paying back, causing it to increase or decrease, such as your college loans, your car loans, or home loans. Well, how does this affect jobs? Well, interest rates, when they increase or decrease, employers may have to lay off employees or hire employees. This could add or cancel projects, add or cancel research and development, or add or slow down production. So in summary, the Federal Reserve was created as a central bank of the United States. Its main goal is to control inflation through its actions of monetary policy. And the Fed impacts the economy and many aspects of our lives, both directly and indirectly. So hopefully you have a better understanding of our Federal Reserve System.